IFCI has made its business in the industrial finance segment. However, operating in this niche alone is unsustainable. India's financial market is liberalising increasingly quickly. If IFCI doesn't take this window of opportunity and diversify and expand, it will fail to be relevant and will risk being squeezed out of the market altogether. Today you've asked us, what should IFCI's turnaround strategy be? IFCI implemented a successful revival strategy following its near collapse in the late 1990s. However, in order to guarantee IFCI's survival in the 21st century, it needs to become a universal bank. IFCI has made its business and its history is in project financing, predominantly in commodity sectors. Following its revival and its restructuring, it has attempted to diversify its business, namely by becoming a small-medium enterprise specialist, as well as entering into new business segments, such as the textiles and real estate segments. In looking at IFCI's turnaround, it has a number of strategic choices that it can take. Firstly, it can maintain the status quo, and that is continue to focus on industrial finance. Secondly, it can look to further expand its small to medium enterprises advisory service. Thirdly, it can take a more aggressive strategy into the investment banking industry. And fourthly, it can look to enter into the retail banking industry. While IFCI's diversification strategy is a positive step in the right direction, IFCI has the potential to become India's preeminent bank. Therefore, we present to you our strategy, Universal Turnaround. Under this strategy, IFCI will look to enter into the retail banking industry. This is in addition to maintaining its industrial finance, as well as continuing to grow its small to medium enterprises division. However, IFCI lacks the capabilities to enter into the highly competitive retail banking market on its own, and therefore we propose that they merge with a national, reputable retail bank in order to effect the strategy. By implementing the strategy, IFCI will see a number of gains. Firstly, they'll diversify their risk profile. Secondly, they'll be able to offer a premium to their shareholders. But thirdly, and most importantly, IFCI will guarantee its survival in the 21st century. That was an overview of our presentation. I'll now hand over to Victoria and Hayden for our analysis and strategy.
In analysing IFCI, there are three key considerations that have informed our strategy choices. The first surrounds risk. IFCI is currently operating in a niche or limited segment of the market. By having all your eggs in one basket, any fluctuations or changes within that industry can have a detrimental effect on your operations.
The second key consideration is the economic trends within the Indian economy. The first of those trends is the trend towards a higher income for India's middle class. This also has the implication that there's more mobile technology being adopted by the Indian public. The second trend is that of the entrepreneurship spirit within the Indian culture. That is, there are more entrepreneurs who are looking to finance their business and create more businesses within India. And the third trend is the liberalisation of the Indian economy. That is, government regulations are beginning to become more slack, which will allow for, one, more foreign investment into the Indian economy, and two, the potential entry of foreign banks, as well as foreign universal banks.
The third consideration that has informed our analysis is that the banking industry is one that is highly dependent on having a strong reputation and having your customers trust the institution that they are depositing money or receiving money from. If you don't have a strong reputation and have a strong record of financial lending, you will be unable to survive within this industry.
So in light of this, we've considered 4 strategic options for the turnaround for IFCI. The first of those options is to make no significant change to your current strategy, that is, just pursue your niche in the industry market. There's a few pros of this. Firstly, it is considered a safe strategy, at least in the short to medium term. You already have the resources to do this effectively, and it is your current core competency. However, it has the con that you're missing out on other opportunities within the Indian market.
The second option that we considered is continuing down the path of having a very strategic and targeted business or advisory focus, particularly around small to medium enterprises. The advantages of this is that you're already developing expertise and capabilities within this area. However, the cons of this is that it is a narrow focus and you risk being squeezed out. You also are not best positioned to take full advantage of the opportunities in both the retail and commercial segment that Hayden has identified.
The third option is to move into an aggressive investment banking segment. This has the benefit that it would receive a high amount of revenue from your customers. However, it has the con that there's already a strong global competition for investment banking services. Also, you do not have the expertise currently to become a market leader in this segment.
The final consideration was moving into retail banking. We see the largest opportunity lies here, with the rising incomes of the Indian population. You are able to provide a broad range of services to your business and retail customers alike within this area. However, the disadvantages of this is your lack of expertise and relationships that are required to be successful in retail banking. It is also trust and relationship based. With IFCI's current position as a project and industrial finance provider, and with the near collapse still in recent memory, you're not well positioned to enter this area alone.
In considering which option we'll recommend to you, there's another consideration that needs to be made. That is of the industry convergence in the financial system in India.
As you can see on the slide behind me, when we look at the financial industry as a whole, there is convergence occurring from both directions. Traditional retail banks are expanding their offerings to businesses and commercial lending. On the other side, investment banks, who originally just provided finance and brokerage offerings to large multinational clients, are now increasing the number of customers that they can provide for within India, as the largest businesses in India grow and the industrial and infrastructure projects become larger. We also see the emergence of universal banks. These are banks that provide the full range of service offerings, from retail clients to multinationals, as well as government or industrial project financing. This is a trend that has occurred overseas, and with India's liberalising economy, this is a trend that we see coming to India in the near future. IFCI's current position is in a niche segment. With convergence from both ends, if IFCI doesn't act soon, you face the risk of being squeezed out of the market altogether.
So in light of this analysis, we have constructed our strategy, the Universal Turnaround, where we recommend that you move into the retail banking space. Currently, you're present in industry, a little bit of investment banking, and a little bit of the small-medium enterprise. However, the large jewel that is missing is the retail banking sector. This will allow you to become more of a universal bank, increase the amount of resources, as well as your customer pulling power.
However, you are not well positioned to do this alone. Therefore, the way that you will move into the retail banking industry is through merging with one of India's big four retail banks. The reasons that you are not well positioned to do this, I have mentioned, briefly run over earlier. The fact that you lack the skills and expertise in this highly competitive and consolidated banking industry. Scale is required in order to offer competitive prices within retail banking. Coming in as a new entrant will not give you a competitive position within the industry. Finally, we had to think about Indian customers' decision when choosing a bank, and they face high perceived switching costs of moving from their current banking provider to a new one. They also need to have trust and loyalty in their chosen bank. Any scare or upset will risk them moving to other banks. Therefore, by merging and partnering with an existing leader in the Indian retail banking industry, you can enter this segment and become a true universal bank. That was an overview of our strategy today. Matt will now talk you through the merger a little bit more.
Thank you, Hayden and Victoria. So I'm going to take you through the merger and how IFCI is in a far better position than it was in the late 1990s. To begin with, let's see what we can bring to the table. First is the growing corporate and project finance. The loan book is increasing 65% to $4,630 million US in 2011. While at the same time, you have a far better credit rating than you did during the crisis period in the late 1990s. This lowers your cost of borrowing, therefore lowering your operating costs and increasing your profit margin. At the same time, you have streamlined your operations through restructuring your business, reducing the number of staff members dramatically, while at the same time reducing the number of fixed assets that you need for operating the business, including reducing the number of locations you have offices across India. At the same time, this has put you in a profitable position with surplus funds ready to expand. We'll now look at what the other partner in the merger needs to bring to the table. The key things is that they need to be in the retail segment. They need to have the retail license from the government to take deposits, which you currently don't have. They need to have a national presence across India with a strong customer base as a result. They too need to have a similar growth ambitions, and they would likely want to enter the markets we are in, including project and corporate finance, to supplement their retail offerings. We also would require them to have a strong credit rating, similar to ours, so that we are both on an even playing field when it comes to borrowing money from foreign companies. As a result, we see India's big four retail banks as perfect people to merge with, and in particular Punjab National Bank, who you previously looked at merging in the 1990s. Let's now look at the benefits that you get from being a new merged bank. The first is the clear economies of scale. The bigger bank is going to be far larger and therefore can reach a greater number of customers and open up a greater number of growth opportunities, while at the same time lowering operating costs from bringing together and reducing the number of duplicate jobs between the two firms. One of the key benefits we see is the risk diversification that your bank will get through this new merger. Currently, your bank, IFCI, relies on project financing, in particular short and medium-term project financing. And you're focused on commodity markets, which are risky due to their ups and downs of the commodity prices. Therefore, by moving to the new together structure, we are now serving the four key areas of banking services, including corporate and project finances, which you bring to the table, along with insurance and services, which both partners can bring to the table due to your current small offering insurance, and then they're bringing retail to the mix. This will diversify the new merged business and lower your risk profile. As a result, your shareholders will see benefits. The first is through the merger, which will attain a premium on their share price, while at the same time the future of the business is now looking much brighter in the new merged bank. This is because there will be lower risk, as I mentioned, the opening up of new markets and new market segments, and of course the scale of this new operation. Therefore, the future of their shareholding is now looking much brighter than if you did not merge. I'll now hand back to Hayden at Victoria for implementation.
So in order to make this merger a success, you need a strong strategy as to how you deal with the preparation for the merger, how you execute the merger, and how you manage your personnel post-merger.
The first thing you need to do is communicate your plan with your senior management team. It is important to get the senior leaders and managers on board so that we can drive real cultural change. Iron out any concerns and kinks they may have first before coming together to decide what exactly you want to see from the merger and what the key strategic financial outcomes should be. At that point, you can start beginning to prepare an RFP to send to investment banks in order to find the right support and service team to see you through this merger. You should also communicate with union leaders by having clear, open, forward communication the whole way throughout this process. We hope that you can minimise any issues or employment concerns they may have. At this point, however, it is still highly confidential.
With regard to the execution of the actual merger, communication is absolutely critical. You need to communicate with your staff as to exactly what their roles will be after the merger. We see there being three distinct business units of the bank created. That focused on retail, a division focused on small-medium enterprises, and a division focused on industry and corporations. In addition, you'll need to merge the IT and auxiliary functions. This will occur over a period of approximately 3 months.
It is important after the merger to make sure that the staff and employees are on board and have bought into being a true universal bank. It is important to make sure the working culture of both your chosen retail partner and IFCI is aligned. You need to communicate with them your vision to be India's #1 leading universal bank and make sure that transitions are as smooth as possible and any concerns and issues are dealt with and communicated in a positive and thorough, meaningful way. We'll also see a creation of a new team, which we'll discuss in the next slide.
So, under the merger, there will be a few key outputs in these separate business units that I've previously mentioned. The focus for the retail should be on capturing more of the mobile market, that is, having an easy, functional application that Indian users can internet bank with. This can then be supported with a marketing drive that your bank, the Universal Bank, is India's People's Bank. Previously, IFCI has had a strong impact on the Indian economy and has been responsible for a large amount of development. In addition, this means that you can leverage that to become India's People's Bank.
There'll be a new division created, purely focused on targeting small to medium enterprises. By having this focus, you can truly become the People's Bank of India. In doing so, we'll have a separate team which is trained to offer business advisory services, entrepreneurial finance, and support in the financial services and business issues for small to medium enterprises. Within this, we see the creation of an angel investment group. IFCI currently does a small amount of investment off its own balance sheet. We see that looking at IFCI's history and heritage, you've been instrumental in the development of the Indian economy, and that is something that we do not want to see you lose. By having a separate angel investment team within the small to medium enterprises group, they will have an allocated amount of money to help out exciting ideas and business plans that are presented to them to help these develop the economy and get small to medium enterprises off the ground.
Within the industrial segment, it will essentially be business as normal for IFCI. This is your core competency and where your resources are currently geared. Therefore, you can just capitalise on the current growing market through industry. Additionally, you should continue to offer your limited range of investment banking services. That is, investment banking that is easy for companies who could not afford a traditional global international investment bank.
That was a walkthrough of our strategy. We'll now pass back to Samantha to address some key risks and mitigations, as well as conclude our presentation.
So we've identified a few risks with the implementation of our strategy and the steps that you can take to mitigate these. The first risk that we've identified is union resistance to the merger. In addressing union resistance and concerns around the merger, IFCI needs to be incredibly clear and regular with its communication with union leaders. Firstly, it needs to communicate the opportunities available to its staff. So whether that be remaining in existing divisions or moving to new divisions, such as the retail banking market. In addition to this, it also needs to communicate IFCI's vision of becoming the People's Bank. That is, their staff needs to be convinced that IFCI has a really clear and bright future ahead of it. In communicating this, IFCI should emphasise that this creates a number of training and career development opportunities for its staff. Finally, IFCI, in the event of needing to make some people redundant, should offer a generous and attractive redundancy package to reward their staff for their years of service. The second key risk that we've identified is the inability to find an appropriate merger partner. There are two potential responses to this. Firstly, IFCI can continue with business as usual for 1 to 2 years, and in particular, focus on growing its SME division. After doing this, it can increase its value proposition to potential merger partners in 1 to 2 years, and then look to become a universal bank. The second potential response is to consider a merger with offshore partners. However, as the government is a key stakeholder in IFCI, you'll need to communicate this intention early on and consult with them. So today you've asked us, what should IFCI's turnaround strategy be? Through our strategy, Universal Turnaround, we've shown you that IFCI can only survive by becoming a universal bank, and that is entering into the retail banking industry through a merger with a national Indian bank. By following our strategy, Universal Turnaround, IFCI can see a number of gains. It can diversify its risk, offer a premium share price to its shareholders, and thirdly, it will survive into the 21st century. 3 things that you can do tomorrow in order to implement Universal Turnaround include a meeting with your management to discuss the future vision for IFCI. Secondly, prepare your RFPs to send to investment banks. And thirdly, begin consultation with union leaders. Thank you, that was our presentation, and we're now open to questions.
Okay, 15-minute Q&A session.
Hi,
how do you see the reaction of the potential acquirer or merger partners? Why do you want to merge? What are the benefits they merge with you from their perspective? What are they lacking?
So the benefits of a merger partner is going to be very similar to the benefits that you are seeking yourself. That is, they will diversify their risk from retail to also have a finger in the game of industry as well as a small medium enterprise. So essentially, they'll be diversifying their risk, expanding their reach, expanding their resources, and expanding their customer base. The same as what will be happening for IFCI.
So would there be other opportunities for them to, to work with other banks better than yours?
As we see, looking at overseas financial markets, universal banks is surely becoming a trend. Therefore, we see that there isn't a window of opportunity in the Indian market for such a merger to take place. We see there being as a couple of years sort of time period before the Indian government is open to having foreign banks enter the market. Therefore, we think that this is a time that you can communicate the benefits to them, communicate that IFCI is the best partner, and take advantage of the opportunity before the competitive pressures within the financial industry in India increase even further.
You've acknowledged that the government is a significant stakeholder. What concerns do you think that the government may have over the proposed merger?
I think the main concerns the government will have will be around consumer protection and the regulation of the banking industry. So with the merger between two very different banks, the government will want to see that they have clear processes in place so that consumers are protected, interest rates are affordable and competitive, so that IFCI can truly become the people's bank in India.
Within this, we see that they don't want to be in a position where they have to act as the lender of last resort or bail out IFCI again. So part of our strategy will be communicating to them as well, as your key stakeholder, the benefits of this merger, and also showing them the financial outputs, and so that they are convinced that you're meeting your liquidity and capital adequacy ratios, and that there won't be any sort of massive job losses or need for them to step in and rescue the bank again in the future.
Well done to your team. So, mine is not more a question to what you proposed. It's more in relation to how we turn around an ailing financial institution. So your strategy and your proposal is more surrounding a long-term plan, how to turn it around, in terms of the bank's positioning in India, right? But I think they have an imminent concern in relation to non-performing assets, inefficiency in terms of the operation process, redundancy of people, some of the unnecessary skills sitting around the bank. So how would you deal with your immediate problem? I think moving to the long-term plan is to make the bank attractive enough to seek partners. At the current state, there's no way they can attract partners, right? It's hard to present the case. So what is your immediate plan to actually turn the bank around in terms of dealing with their current problems?
Our strategy had a more long-term focus because we believe that the steps that IFCI is taking currently are really strong improvements and also in the right direction. So we see that in 2011 you got to 0 non-performing assets, and in positioning yourself to be attractive for a merger partner is really important to build your reputation, build your number of SME and industrial customer base, and make sure that you are adopting those stringent strategies around asset allocation and choices in your customers and loan providers. So that's making sure that they have sound financial projections, analysis, and good credit ratings before you consider making any loans to them. In this way, we can maintain your new or renewed strong credit rating and maintain that minimal bottom floor level of non-performing assets. On the operational side, we again see that there has been efficiencies and gains realised with the changing over of executives from 2006 onwards. We need to keep employee retention high. Within the case, it's been seen that the employees feel valued and excited to work for IFCI as an important contributor to the Indian economy. The reason our strategy was based more on the longer term is because your short-term strategy is sound and really crucial for attracting a partner. If this is continued to be done successfully, we see that within the longer term, not only can we remove any kinks within IFCI's current operations, but also be well positioned to survive within the Indian financial sector.
Okay, thank you.
For the presentation, I see that you proposed the IT merger sort of thing to 3 months time, right?
That was more for the beginning of the IT merger. So obviously it's very difficult to reconcile two IT systems immediately. However, within people beginning to work, within sort of 3 months you should start beginning to reconcile the auxiliary functions and the IT system. It might not necessarily be 3 months, but 3 months at least to begin and start moving towards a centralized IT system.
More useful. Doesn't it take a long time to
Yes,
merge
that's a fair comment.
Thank you.
And actually, leading on from that is, what do you envisage will be some of the challenges around the actual implementation of the integration?
Some of the challenges will be employee resistance, shareholder resistance, and market perception. These are probably the early possible challenges that we face, rather than the more implementation or logistical sides. The way to combat these is through clear and open communication. The first announcement to the market of the proposed merger is crucial. It's viewed by shareholders and the general public as being a positive and value accretive movement. Within employees, again, we've adopted a sound communication, or we propose a sound communication strategy in order to convince them that their jobs are going to become more attractive and more exciting, as opposed to them risking losing their jobs or seeing it as a negative step. Would you like to cover some of the implementation challenges?
Yeah, so the key problem that we perceive is that having a kind of siloed approach means that, one, you might have, I'm a retail banker and my friend over here is just in industry, and we're not really that connected. The second issue is that when you merge two companies, it's quite often to be, I'm an ex-IFCI and I'm an ex-Punjab. Those can be very difficult to reconcile. So the most important thing is to have a culture of unity. That is, both employees from ex-IFCI and Punjab and from the retail and the industry are on the same page. And that will be done through the communicating the vision soundly. That is, that you are aiming to be the People's Bank of India. Your employees already currently really relate to the fact that you've been central and pivotal to the development of the Indian economy. For them, that is a huge driver. And we believe that will be the exact same driver in the Punjab National Bank. So by communicating the fact that these two banks coming together, that their synergy will be able to increase the development of the Indian economy, and that every member at the bank is playing a pivotal role, will be able to alleviate most of those concerns.
So my question is around why retail banking? Are there any internal strategy or reorganization you can consider instead of looking for a merging partner?
So retail banking we saw as a huge growth opportunity within India. The Indian middle class is starting to become much more populous and much more ready to spend. India is currently operating on a cash economy, however we see that converging to a bank account economy. In combination with the mobile technology that most Indians currently possess, this presents a huge opportunity for banking to essentially just explode within India as it has done around the world. Therefore, by moving to retail banking, you are able to capitalize on that opportunity. However, we didn't really consider any further internal strategic reorganizations beyond what you're already proposing or what you're already implementing, as we chose to focus on the huge growth area that is retail banking.
And what is your plan B?
Plan B is essentially to just continue developing your industry and to potentially look into more, continue developing your industry side as well as your small medium enterprise. You are able to create a strong small medium enterprise bank on your own. You don't necessarily need the merger of another bank to do that. However, having access to the retail side is a huge growth opportunity, as I've mentioned, and will also lend itself to extra resources that will make that more effective.
Okay, thank you.
My last question will be on the culture part. So the retail banking, they more on the voice of customers, the customer oriented, right? So some kind of people-oriented mindset. For the touch financing, they will be the rather than the people. So there are different kind of people, right? Different animals here. How do you merge different cultures here? How was the strategy bring to their own, so sort of their centralized thing? What is the culture for the universal bank to be? What will the future culture is?
As mentioned, under our proposed universal merging banking strategy, there'll be different divisions. It is important to have a cohesive and aligned culture from the top, but that doesn't mean that the way that they approach business or that their different targets within divisions also needs to be aligned. So you've correctly identified that within the retail side of the business is a very customer-friendly, people-first type attitude and culture. We do want that to translate across the business, as we believe that in gaining project finance and industrial and commercial finance as well, the focus also needs to be on relationship building with people as much as it is on the project. That doesn't mean that they will approach those two customers in the same way, as we see that obviously an industrial or infrastructure-based client has different needs, and it needs to be a different sort of value pitch or proposition needs to be presented to that customer than a retail banking customer. But we don't see this as being an insurmountable challenge. So long as the employees all feel like they are part of this universal bank, whether it be IFCI Punjab or another Indian retail partner, as long as they have the shared vision and goal of being the People's Bank of India and the leading universal bank in India, that is the most crucial part of our strategy. And as Hayden mentioned previously, as long as they don't see themselves as INEX Punjab, INEX IFCC, IFCI, and etc., we see that as not being an insurmountable challenge. And we do see the new merged bank as having a very strong people core and people service focus.
3 minutes left.
Okay, I don't have a question. You have a question?
Just a final question. Have you considered what potential opportunities or synergies there are across the existing customer bases, across your institution and the proposed merger target?
Sure. So your two customer bases are kind of your industry customers and then your retail customers. So from the IFCI side, your commercial customers can also begin to offer their staff a retail IFCI bank account and gain customers in that way. From the retail side, people who have individual personal checking accounts with IFCI Punjab can also go to the same shop, the same bank, in order to service their business needs. So in that way, we see there to be a significant crossover in terms of the customer use of our cohesive range of services.
Yeah, and just to build on that, the customer synergy is only one part of the synergies that will be available. Because you'll be a bigger bank, you'll also have greater resources, which will enable you to offer lower rates across your customer, your small medium enterprise, and your industry segments.
One suggestion is, if I'm you, I would focus on more the immediate problems that IFCI need to solve. I think it would take years for IFCI to come back to shape. So merging is a good idea, and looking out for retail banking as one of the strategic partnership is a good idea. But as one of the key statements that I read from the note given to me is that IFCI is losing money every day, every minute, any second. And there is some immediate issues that they need to turn around before they can make it attractive as a proposal to a partner. So I think worth considering is, what is your proposal in relation to how to keep the bank going, right, instead of going into receivership? That is the next step.
Yeah, we were operating on the understanding that the strategies that the original board has proposed has started to already turn the bank around, that you're seeing the capital adequacy ratio go from being negative to positive, and we don't see any reason why that is not going to continue into the near future. Therefore, we chose not to focus on the immediate strategy, as it seems that the board of directors has already got that pretty well down pat, and instead is focused on the longer term issues.
Okay, good. Thank you.
Any other questions? Okay, thank you, the team from